I went into his office and I said, I think we should start an Asia fund. I've done the analysis, I've looked at the market. And he got on the phone and called the COO and said, we're starting an Asia fund and it's going to start next week.
That is what happens.
When you started digging into what they were doing on the trade front, it became quite obvious to us that it was actually about tech. It wasn't really about trade, and soybeans are not the flashpoint in US-China geopolitical tensions. It's ultimately this trade war is going to lead to a tech war. If you look at the size of the economy and the number of stocks that are available here, and then you look at the percentage of people's portfolios that are allocated to Australian equities, it doesn't make sense to me. We're a growth fund, so every stock has to meet growth criteria. So even if you're the most amazing thematically based stock and you're going to win in the tech arms race, but right now you have no growth, we're not going to invest in that kind of stock. And that's why I like some of these domestic mega cap leader companies like Tencent and Alibaba and JD, because they're going to be winners in that environment. If I look back on my career, one of the best things is that I have been very, very blessed to work for such amazing people in the finance industry. And when I started working at Soros, I was literally fresh out of business school. I had graduated about 2 weeks before, and I was pretty clueless, to be honest. And working for Soros, I mean, he wasn't in the office, that often. And actually, the first time I met him was not even in the office. It was at Council on Foreign Relations, which is a big body in New York that brings in a lot of experts and presidents and whatever. And so it was, Prime Minister Koizumi, who was the Prime Minister of Japan at the time, was giving this presentation, and I went up and introduced myself to George, and I said, actually, I work for you. And the next time I ran into him was also at Council of Foreign Relations with, Thabo Mbeki, who was the president of South Africa at the time. And the reason I mentioned that is because one of my takeaways from working at Soros was that he and the organization were very big picture thinkers. To short the pound the way he did, that's not something that you would come up with by sitting at your desk and, nitty gritty in terms of, is the stock trading at the right P or something. You have to have a very big worldview in order to identify those sorts of trades. And the fact that even at the age he was then, he's rocking up to, meet with prime ministers and presidents and keeping that worldview very big is something that was, quite interesting to me. And also the fact that, he made his money into the name for himself as doing shorts, I think is interesting. So I obviously run funds that are only long only right now, but just having that background in terms of, markets can be mispriced and there can be things in the markets which are very, very wrong. And one trade can make your whole career. It's important even for long only investors to keep in mind because, you don't want to get complacent about the things that you own.
What was it like at Oaktree?
Yeah, so Oaktree was an amazing place to work. It was very structured, unlike Soros. It was very, very structured. And I think you and I have talked about this before in terms of sometimes, being a good investor and building a business are two totally different skill sets. And one of the things I appreciate about Howard Marks is that he's obviously an amazing investor, and the genesis of Oaktree was in distressed, which is similar to what I said about George. Like, you have to think differently to be a distressed investor. When everyone else is running for the hills, that's when you step in. So thinking differently, but also having the sort of mind and execution skills to be able to build a business is pretty rare to have both those things in the same individual. So when I first started at Oaktree, the fund wasn't very high. It was primarily distressed, and I worked for the Emerging Markets Hedge Fund. And then over the time that I worked there, and then even after I'd left, they built it up to be many different products and offices all around the world. And then they did a backdoor listing, so there was some liquidity, and then they did a full IPO, and then they got acquired. So the fact that you could build a business from like a niche distressed business to a behemoth that gets sold in 2 decades-ish, I think is pretty impressive.
You run Ellerston Asian Investments. Ashok Jacob is the head of the firm there. Tell us a little bit about how that experience that you've had from that investing journey to bring you to where you are now influences how you invest, and maybe tell us a bit about the influence that Ashok's had as well.
Yeah, so I think unlike George and Howard Marks, Ashok, I actually work with him. It's not someone who I see, a few every once in a while. Ashok, it's a very engaged relationship, and I really appreciate that as the chairman of Ellerston, he is very engaged and he knows what's in your portfolio and he knows what people are doing. And I would say in the same sort of category as George Soros and Howard Marks, his breadth of intellect is very impressive, and I really appreciate having someone that you can talk to about anything and that knows what's going on in every country in the world and has that sort of expertise and the breadth of intellect. That's very nice for me as a portfolio manager to have a boss like that. And also, Ashok, because I run an Asia fund, and we also have an India fund at Ellerston, to have someone who has expertise in investing in Asia is pretty rare in Australia, frankly. If you look at the chairman and CIOs, to have people who are experts in investing in Asia, I feel very, I think it's wonderful to have Ashok as a boss.
So tell me about the opportunity that you saw and how you think about investing in Asia. Like, what's your philosophy?
Yeah, so the opportunity that I saw, and this was 5-6 years ago now, is that first of all, I think that Australia then and still today is very, very domestic focused. I mean, extremely domestic focused. If you look at the size of the economy and the number of stocks that are available here, and then you look at the percentage of people's portfolios that are allocated to Australian equities, it doesn't make sense to me. So I'm not a financial advisor. This is not financial advice, but it makes no sense to me. And I also feel like a lot of investing in Australia is sort of a circular trade. So if you buy an Australian bank, it might be the same bank that you have your mortgage in and your investment property in, and your everything becomes a circular trade. So to me, after living here for a while, it was just a market that was screaming out for diversification. And you have seen some funds which have been very successful in taking that diversification trade and getting people into global equities. And that was a genius business path to take down for some other funds in the Australian market. But in terms of investing directly in Asia, there was Platinum at the time, and there was another small fund, but really there was not a focus on Asia. It was, and still today there's not a focus on emerging markets. It's like there's Australia and then there's global, and that's it. But the type of companies that you get access to in Asia and emerging markets are very different, obviously, than what you would get in developed markets. And when I look at developed markets, including Australia right now, and this is where I do have a PhD in economics, as we've discussed, I do have a macro sort of brain, and I don't see very many growth opportunities in the world. So in developed markets, I mean, Japan's been stuck in the doldrums for decades now, and Europe has been stuck in the doldrums since the end of the GFC, and despite over a decade of ultra loose monetary policy, there's no growth. The US has managed to get some growth, but only again because of ultra loose monetary policy and major fiscal spend. So if you look around the world, structural growth is extremely scarce. But if you look at Asia, there's lots of structural growth. Now let's put COVID to the side for a second, but you have demographics, you have technological leapfrogging, you have infrastructure build, you have rising middle class and rising consumption, a lot of these structural changes. So it's hard to find growth in an Australian portfolio. And Asia is a region which is right next door and has lots of amazing companies that can give you structural growth. So that's the opportunity that I saw. And then to answer your question about my philosophy, so all the funds that I run at Ellerston are growth funds. We're not going to Asia for value or dividend yield. If you want that, you can get it at home or somewhere else. But Asia is the best structural growth story in the world, so that's why I think you should be investing for Asia. So that's a big part of my philosophy.
What's been behind that positive momentum and those strong returns in Asia? Is it consistent? Is it homogenous? Is it different drivers?
No, so it is not consistent. I think it's technology. So I think, and this is probably not particular to Asia, although this is where my area of expertise is, the technology sector is driving markets globally. And so if you look, within Asia, countries that have no tech, their markets are not doing very well. I mean, Thailand, Malaysia, Philippines, Indonesia, there's no big listed tech companies in these countries, and they're doing quite badly. If you look at countries which have a lot of tech, China, Korea, Taiwan, their markets are doing very well. It's a little bit complicated right now because Korea, Taiwan, and China were also the first in, first out countries. But I think it's those technology stocks that are really driving things, not dissimilar to the way that NASDAQ is really driving things in the US.
Are you seeing the same concentration in sort of narrow leadership of stocks in those Asian markets as well?
Yes. So, India is a good example. So Reliance, which is a stock that we like, it's 16% of our India portfolio, and it's a decent weight in the Asia portfolios. It wants to be the 10 cent of India, and right now it's still a conglomerate, but it has this new economy business, which you may know a lot of big US, like Google and Facebook have invested in it, and it is single-handedly dragging, for a while there during COVID, was single-handedly dragging the Indian market up, just one stock. So between the bottom in March, it was at 900, and now it's over 2,000. So when you have a stock that's 14% of the benchmark, that's doubled since March, that market's going to look like it's doing very well. But really, it's just that concentration in leadership which is driving that.
Well, you referenced the US market there and the NASDAQ. When people think about China and the US markets at the moment, a lot of the focus is on trade tensions and on geopolitics. In 2018, you put together a white paper or a research paper where you basically said that the tensions was about technology rather than about geopolitics and trade. Could I get you to explain that thesis and give me a bit of a view on why you hold that position and how it's played out since 2018?
Yeah. Okay, so you're right. More than 2 years ago, me and my team started putting together some thoughts on, we started actually looking at the trade war because that was the defining characteristic of US-China relations at that time. And at the time, you remember there was this Section 301 of the Trade Act, and it was, Trump and Navarro and Lighthizer and a lot of the people in the Trump administration were going really hard on Section 301. And we thought, why is that? And Section 301, it was a lot about IP theft and technological transfer and stuff. And when you started digging into what they were doing on the trade front, it became quite obvious to us that it was actually about tech. It wasn't really about trade, and soybeans are not the flashpoint in US-China geopolitical tensions. It's ultimately this trade war is going to lead to a tech war, and that's what's actually underlining it. So we did this, as you said, it was a very detailed white paper about 2 years ago, and we presented it to a number of our investors and people, and they were like, that's nice, okay, good work. And then recently, when you've seen all this, even last night, a big crackdown on Huawei and TikTok and WeChat, and a lot of these things that have come out just in the last few weeks, we've had investors call us and say, remember that thing you did 2 years ago about the tech, technological arms race, or the tech Cold War, it's also called. So it's really in the front of people's minds right now. And so our main thesis was that the trade war is not about trade, it's ultimately going to be about tech, and that is playing out right now. But what does that mean from a portfolio perspective? So, I have almost 50% of my portfolio in tech right now. It's actually 47%, but I have about 18% cash. So if you adjust for cash, that is a very big bet on tech right now. And I think Ray Dalio said it better than I ever could, that if this is a two-horse race between China and the US in terms of global economic dominance and dominance in tech, why wouldn't you bet on the second horse? Because the US has been running around the track for a long time now in the lead, and China has been catching up, and that was part of our white papers showing the speed at which China has caught up in tech. Why wouldn't you bet on the second horse? So in an Asia fund, yeah, we have a huge bet on the second horse right now. Companies like Tencent, Alibaba, TSMC, well, these are not China stocks, but Asian technology stocks, Samsung, TSMC, supply chain stocks, Reliance, JD, Baidu, there's a whole amazing suite of stocks that investors can have access to, which will do very well. Not as the tech trade war continues, but the fact that the U.S. is so nervous about this suggests that there's really something amazing going on here, and that's why they're pushing back so hard.
When I asked you what you thought the biggest issue in Asia right now, you corrected me and said this is not just the biggest issue in Asia, this is actually the biggest issue in global markets, and that is the technology arms race. Why is it such a big issue?
Well, I think it's a big issue for markets to draw on what we discussed before in terms of the technology stocks are the biggest in the world now. So this is not, when it was the trade war and it had to do with soybeans, or remember Trump, the first thing he came out with actually was about steel. And, okay, so if steel companies in Asia go down, 5-6%, that you might not even be able to notice it in the overall market, because materials is a single-digit percentage, and within that, steel is very small. So I guess the reason technology is so important is because they're the drivers of the market, and it's the biggest weight in a lot of markets now. But it's also because technology actually impacts our lives. Like, I hate to keep bringing up soybeans, but if the soybean price goes up, for us, it's really not going to make any difference. But for Australians, for a lot of the people on my team who are Mandarin speakers, if WeChat gets banned in Australia, that actually makes a big difference. If Huawei gets banned across developed markets, that can actually make a big difference. So, Treasury Wines today, that makes a big difference for stocks. So I think that's why it's the most important thing for markets now, is because technology, what's driving it, and anything that sort of threatens people's certainty and tech leadership, it can have big impacts.
And is there a reason why we can't have two winners? There's often this concept of winner takes all. You have the leaders in Asian markets and the leaders in Western markets or out of the US. Does it have to be a one versus the other?
No, not at all. In fact, the splinter net, which you've probably heard that term, that may very well be where we're heading, and that you have leaders in China or leaders in China and China-aligned countries, and you have leaders for America and America-aligned countries, and that's it. So that's maybe where we're heading, and that's why I like some of these domestic mega cap leader companies like Tencent and Alibaba and JD, because they're going to be winners in that environment. The tech supply chain is the only, not the only, but probably the best example of how that doesn't work very well. It's called a supply chain for a reason, and that would be very disruptive. It would be, I think it would be strange to have like Apple, and you wouldn't be able to have an Apple supply chain in the US. That's something that was explored in the early days of the Trump administration. Your iPhone would cost $5,000 or something ridiculous like that. So the supply chain is something which is not going to splinter, but e-commerce, internet, mobile, a lot of other subsectors in technology certainly you could end up with two silos.
Let's stay on the subsectors. Talk me through the scorecard. What are the contested areas, and who's winning in which area?
So this was one of the interesting things that came out of the report is China, when Deng Xiaoping was the president, he had it was like called hide and bide strategy. So hide your strengths and bide your time. And it was actually quite effective because China snuck up on the rest of the world in terms of its abilities and technology, and a lot of people are surprised at where China is now. So we have a list of different subsectors in tech and who's ahead, China or the US. I'd say in e-commerce, China is definitely ahead. Part of that is just because they have a bigger population, but if you look at GMV and sort of certain aspects of penetration, I'd say China is ahead. Fintech, China's definitely ahead. So the Ant Financial IPO is coming up in the next few months. That's going to be a $200 to $250 billion public market cap fintech company. Green tech, now I think China's ahead. So some people would say, come on, China has this reputation as being highly polluted. They can't possibly be ahead in green tech. But the investment in EVs and a lot of the things that go along with EV, China is definitely ahead in that. I'd say the places where the US is definitely still ahead are AI. China has a strategy called AI 2030, which is their plan to be ahead by 2030. So the fact that they're so upfront about that is telling you something. The US is definitely still ahead in military technology. Now, some of that may be that we don't know where China is on military technology, but from what we know, the US appears to be ahead. US is ahead on semiconductors. And US, I think their biggest strength is that they're ahead in terms of software for mobiles. So every phone in the world runs on Android or iOS. Every phone in China runs on Android or iOS. And that's a big weakness in the sort of Chinese technological landscape, that if that was ever withdrawn, China would have big problems. So that was sort of our scorecard in terms of who's ahead in which subsectors.
How are you choosing to invest in this? Like, how are you placing your bets?
So we have a very defined process for how we pick stocks, and a thematic is only one part of the process. So if the technological disruption is the thematic, and where they are in the tech arms race would be a sort of sub-thematic for that. So just in terms of how me and my team invest overall, we're a growth fund. So every stock has to meet growth criteria. So even if you're the most amazing thematically based stock and you're going to win in the tech arms race, but right now you have no growth, then we're not going to invest in that kind of stock. So first, all companies, including tech, have to have high growth. Then there's a valuation analysis. They have to have at least 50% upside in 3 years. Then look at industry structure, because there are some stocks which may be winners from this technological arms race, but they have very bad industry structure. So a lot of the supply chain companies. I mean, if you're a supply chain company and 90% of your sales come from Huawei, that's not a good place to be.
It's a vulnerability, yeah.
Yes. So we look at industry structure, and then look at thematic, and then we look at management and ESG. ESG is something which actually, my funds take very, very seriously, and we have for since inception. This is not something we've come up with overnight because a lot of clients are asking for it. So companies get a score on all those metrics, and then if you come up with a high score, then we do a deep dive analysis. So the kind of companies that pop up through this sort of analysis are obviously national champions. So Alibaba and Tencent, which are very well known to Australian investors, but they meet our growth criteria. We have a preference for large cap for a number of reasons. And if you think of how China is sort of responding they are supportive of national champions in the technology industry. Whereas in the US, you have congressional testimonies where a lot of lawmakers are going after big tech. So if you're a big mega cap tech company in China and you meet our criteria, we actually like investing in those kind of companies.
Because of the government support?
Well, yeah, the government support is there, and it's certainly not against them. They want these companies to succeed, and that's a nice place to be. And by and large, they are succeeding. They have impressive management, very good execution. So those sort of big cap end of town is important. We own stocks like Samsung SDI, which makes batteries for electric vehicles. That's in Korea. Samsung and Hynix, the memory companies, those meet all our criteria, and there's a cyclical element going on with memory right now. In India, as we've discussed, really like Reliance. There's a major scarcity value in India in terms of these new economy types of companies. Reliance now has a market cap of like over 150 billion, which a lot of people are surprised that there's a 150 billion market cap company in India. So that's sort of how we're playing it right now.
You talked about the run up from the retail, the participation of retail investors in some of these technology stocks and being wary of it. Are there some of those big names where you've got more conviction than others, or you feel like the valuation has pushed through the levels that you're comfortable with?
So I have been very disciplined in taking profits. Throughout the last 6 months, Naver is example, the Google of Korea, where we've taken profits. I think in terms of the big names, which people would know, maybe it's my economist hat being on, but I look at who's the marginal seller and who's the marginal buyer. And right now, I see a lot more marginal buyers in Alibaba than I do in Tencent. So Alibaba, as you know, it first listed as a ADR in the US, and then because of all this political tension and whatnot, they have a secondary listing in Hong Kong right now. But up until a few days ago, it wasn't part of the Hang Seng Index, and it also is not yet eligible for Connect. So southbound Connect is mainland investors in China can buy your stock in Hong Kong. And so, I think that there's a lot of marginal buyers, because once that is allowed, you'll have, it would be weird. It would be like Australia's
like index inclusion for ETFs and passive money.
Yes, and also just mainland investors being able to buy Alibaba, because previously most people couldn't buy it as an ADR. It would be like Australians not being able to buy CBA and BHP. It's just weird. So as soon as that is allowed, you have 1.2 billion marginal buyers for Alibaba. Alibaba has also lagged JD and some of the other big tech companies. So Alibaba is currently the largest position in our fund right now at about 10.7%.
Those names, Alibaba, Tencent, they're ones that people are familiar with.
Yeah.
What people sometimes say to us is, what are some of the emerging companies in Asia? What's the next big thing going to be? This is a part of the world where that's what you're trying to do. You're trying to find these next growth stocks. So what's an example of a company in Asia that meets those growth criteria that you're looking for, but people don't know, it's not a household name yet?
Okay, before I answer your question, I'm just going to push back on that a little bit, because part of the reason we like large caps and why our strategy is focused on large caps is that I think in this sort of environment, if you're big, it's easier to get bigger. It's much harder to be a startup and to be, gaining market share, and you've just seen a sort of dichotomy of the small die and the big get bigger. And so I actually think that the next big thing is the current big thing, and that the next big thing to come out of Asia is actually going to be from within the big companies rather than some tiny startup that we've never heard of.
For share.
Yes. Yeah. So the next big thing could very well be Ant Financial, which is part or affiliated with Alibaba, and you can't buy it now, but that could be the next big thing. Or the next big thing might be Tencent Tenpay, which is their payment system. Or it could be industrial internet things for Tencent. Or it could be Samsung coming out with a new kind of phone that's they already have some of these, but like foldable, or new sort of innovation on that front. So that's actually and if you look at some of the parts of some of these big cap tech, you can see that they are constantly on the lookout for the next big thing. And that's why, Tencent is actually one of the biggest VC funds in the world, which a lot of people don't realize. But if you look at the number of VC investments that they make, I think the last thing I read, they were third in the world. And so I think that the next big thing is going to come out of that. But to answer your question specifically, we like an A-share tech company called Hundsun. It is actually it does software for financial companies, including Ant Financial. So that's sort of how we found it. Was you do work on Alibaba and you have a valuation for Ant Financial and you're some of the parts, and you figure out who are the suppliers to Ant Financial, and you come up with some interesting ideas. MediaTek is one that we've held for a long time in Taiwan, and it's actually doubled since we bought it, and we've sold some, we've trimmed that position. And then I think in India, there's going to be some interesting ones. These are not the next big thing, but some of these companies that have been around for decades, like Infosys and TCS, they are at the forefront of digitization. And COVID has just pushed digitization, decades, accelerated that move to digitization much more than people thought it would be. So Infosys, which maybe 5 years ago people were saying this is a boring IT services company, now you have every company in the world needs to digitize super fast. And their stock prices has been on an absolute tear. So those are some examples.
I'd like to ask investors when they come in to tell us about a lesson, something that was a bit painful, something they had to learn the hard way, a mistake that you've made along the way that you could share with us, and more importantly, tell us about the lesson that you took out of it.
Okay, so there's so many. I don't know how I'm going to narrow it down. So maybe you asked me before about the different places that I've worked. Maybe I could share one from each place. So my worst mistake at Soros was to be short a stock, Household International, that got taken over by HSBC. And to be short and then get something taken over at a big premium is like the investor equivalent of getting kicked in the gut. Like it all just happens at once, and it's terrible. So that was my big takeaway from that. Never short anything that's a target.
Yep, right.
That's a target. From Soros, it's not so much a mistake, but it's something that Robert Soros, who's George's son, said to me, which has literally stayed with me through my career. So I was a financials analyst before I was a PM. I covered just banks and financials for many years. And he said to me one day, most industries are about the income statement, but financials are about the balance sheet. So forget about the income statement, become a forensic balance sheet analysis, and you will always be able to make money in financials. And that has been a very good takeaway for me. Even in my fund now, even though I'm the PM, I'm still the financials analyst. And it's literally important right now because I've gone through every single financial that we own in Asia and said, okay, if COVID results in the worst NPL crisis, worse than GFC, do these companies need to raise capital, and what do their balance sheets look like? And it's been very informative in terms of how to invest in this sort of environment. So that's not necessarily a mistake, but that's a big takeaway from Soros. And then Ellerston, I invested in a company which had a short seller report when I was at Ellerston, working in the small cap fund. And it is instilled in me an absolute fear of short seller reports. So that is one small reason, but is one of the reasons why we have very, very strong ESG criteria in my funds, because I never, ever, ever want any of the stocks that I own in the portfolio to be targeted by a short seller. Now, a lot of the short sellers in Asia, they're kind of flaky, and some of their reports are true and some of them are not, but sometimes it doesn't matter, the damage is done. And so I guess, yeah, that's a good takeaway, is that make sure you're investing in high quality companies with no warts and amazing governance, because that can ruin a whole year's worth of performance if you get hit by a short seller.
Mm. Now you gave me Soros. Did you give me Oaktree?
So Oaktree is working in emerging markets fund, and Tim Jensen, who is one of the portfolio managers or the CIO equivalent at Oaktree, he refused to invest in countries that had current account deficits. And his rationale was that you're always going to get screwed over on the currency. And so this, he wouldn't touch South Africa, wouldn't touch Turkey, wouldn't touch some of these Eastern European countries, didn't like India. And it was an extreme view, but if you note over time, it's actually not a bad view. So almost every country, with the exception of India that I'm invested in Asia now, has current account surpluses. And it's just a helpful way. I think a lot of domestic Australian investors, they only have one country to invest in, and it's a very sort of narrow way to invest. But if you're running an emerging markets fund, you have like 20 plus countries to think about. Even in Asia, we have 13 different countries to invest in. So having a macro framework for which kind of countries you like and which you don't has been helpful.
So there's some pretty advanced tips that you've given us.
Okay.
You said that you've been observing a bit of Robin Hood style training going on during COVID lockdown.
Yep.
Coaching your son through a bit of investing.
Yep.
So what's the advice you give to your 13-year-old son as he's thinking about buying some shares?
Okay. I'm laughing because I felt like the Warren Buffett of parenting. So I do have a 13-year-old son and I have a 10-year-old daughter. And my son's teacher at school said during school holidays, this was in the April school holidays, you should try to teach your child a new skill. And at the risk of sounding like a loser in front of all your audience, I was like, what skills do I have? The list was very short. So I was like, well, I do know how to invest in equities. So I explained everything to him. And actually, my kids have been looking at Bloomberg since they were very little. Because sometimes I'm driving and I need to check my stock prices. So I'm like, guys, just look at my Bloomberg on my phone and read them out. So he was already pretty advanced. But anyways, I said, listen, investing is hard. So only buy stuff that you understand, that you know what you're buying. So he bought like Nike because he's a 13-year-old boy and he wears Nike shoes and he knows about them. And he bought Apple because he has an iPhone. And to be fair, he bought Apple at like $250, and he's done pretty well. So that was the advice that I gave him. So he had a certain amount of money and he kept half of it in cash. So, just general things about buy businesses that you know and also manage your risk. So you don't want to put everything in at once. Keep some powder dry. You have a long-term investing horizon. But frankly, I didn't start investing until I was out of uni and actually an investment banker. And I think the sooner you start, the better off you'll be, because it's all about learning lessons. I learned different lessons every day. I think in 2020, every single investor in the world has learned a lot of different lessons. So the sooner you can start learning those lessons, the better off you're going to be.
Awesome. Well, Mary, great to catch up.
Thank you.
Really interesting to talk about the technology arms race, and thanks for your time.
Great. Thanks very much, James.